How to evaluate dividend stocks. Key metrics you need to know. Hey everyone, welcome back to the channel. In previous videos we've covered how to build and diversify a dividend portfolio, but today we're diving deep into the specifics of evaluating individual dividend stocks. Whether you're a seasoned investor or just starting out, understanding the key metrics for assessing dividend stocks is crucial for selecting the best companies that can provide consistent income. Think of it like buying a rental property. You wouldn't just look at the monthly rent, you'd also consider the property's condition, location, and potential for appreciation. Same goes for dividend stocks. We need to look under the hood. Let's break it down. Dividend yield. Don't be fooled by high numbers? Alright, let's kick things off with dividend yield. Probably the first thing most people look at when they hear about dividend stocks. It's a metric that can be very enticing, especially for those new to investing or those looking for a steady income stream. But, as with many things in the financial world, there's more than meets the eye. Now, the dividend yield is simply the annual dividend payment per share, divided by the stock's current price. This calculation gives you a percentage that represents the return on your investment if the price and dividend stayed the same. For example, if you have a stock priced at $100 and it pays a $4 annual dividend, the yield would be 4%. It's essentially the return on your investment if the price and dividend stayed the same. This can be a useful metric for comparing different dividend-paying stocks, but it doesn't tell the whole story. So, a $100 stock with a $4 annual dividend would have a 4% yield. Sounds simple enough, right? But here's where things get tricky. A high dividend yield might catch your eye, but it's crucial to understand what's driving that number. But here's the catch. A high dividend yield isn't always a good thing. Sometimes a really high yield can be a red flag, like that bright yellow caution tape around a construction site. Why? Because a high yield can sometimes indicate that the stock price has dropped significantly. Sometimes a really high yield can be a red flag, like that bright yellow caution tape around a construction site. Why? Well, imagine a company's stock price tanks because their earnings are down. The dividend yield might look super juicy, but it could be a sign of trouble. Well, imagine a company's stock price tanks because their earnings are down. The dividend yield might look super juicy, but it could be a sign of trouble. When a company's stock price falls, the yield goes up, even if the dividend payment remains the same. This can be misleading. The dividend yield might look super juicy, but it could be a sign of trouble. Remember, the yield is calculated using the stock price, so if the price drops significantly, the yield shoots up, even if the actual dividend payment hasn't changed. This can create a false sense of security for investors who are only looking at the yield percentage. Remember, the yield is calculated using the stock price, so if the price drops significantly, the yield shoots up, even if the actual dividend payment hasn't changed. It's like thinking you're getting a steal on a used car, only to find out it needs a new transmission. The high yield might be masking underlying issues with the company. It's like thinking you're getting a steal on a used car, only to find out it needs a new transmission. Always investigate why the yield is so high before jumping in head first. Look at the company's financial health, earnings reports, and future prospects. A high yield might be tempting, but it's not worth the risk if the company is in trouble. Always investigate why the yield is so high before jumping in head first. Look at the company's financial health, earnings reports, and future prospects. A high yield might be tempting, but it's not worth the risk if the company is in trouble. Do your homework, and make sure you're not just chasing high numbers without understanding the full picture. In conclusion, while dividend yield is an important metric, it should never be the sole factor in your investment decision. A high yield can be attractive, but it can also be a warning sign. Always dig deeper, understand the reasons behind the numbers, and make informed decisions. Your future self will thank you for it. So the next time you see a high dividend yield, don't be fooled by the numbers. Take a closer look, do your research, and make sure you're making a wise investment. After all, in the world of investing, knowledge is power. Payout ratio, the dividend sustainability check. Next up, we're talking about the payout ratio, and trust me, this is a big one. It's one of the most crucial metrics for investors who are keen on dividend-paying stocks. Think of this as checking if the company can actually afford to keep paying those dividends. It's like making sure your friend can keep up with their monthly rent before they splurge on a vacation. The payout ratio tells you what percentage of a company's earnings is being paid out as dividends. This ratio is a clear indicator of how much profit is being returned to shareholders versus how much is being retained for growth and other expenses. So, If a company earns $1 per share and pays out 50 cents in dividends, the payout ratio is 50%. This means half of the earnings are being distributed to shareholders. Seems straightforward, but here's where it gets interesting. The payout ratio can reveal a lot about a company's financial health and its future prospects. A high payout ratio, especially anything above 60% to 70%, could be a warning sign. It suggests that the company is distributing most of its earnings as dividends, which might not be sustainable in the long run. It might mean the company is shelling out most of its profits as dividends, leaving little room for reinvestment in the business, debt reduction, or those rainy day funds. This could limit the company's ability to grow and adapt to market changes. Imagine trying to live paycheck to paycheck and still afford a fancy car payment. It might work for a while, but any unexpected expense could throw everything off. The same principle applies to companies with high payout ratios. Same goes for companies with high payout ratios. They might be forced to cut dividends if their earnings take a hit, which can be bad news for investors. A sudden dividend cut can lead to a drop in stock prices, affecting the overall value of your investment. They might be forced to cut dividends if their earnings take a hit, which can be bad news for investors. A sudden dividend cut can lead to a drop in stock prices, affecting the overall value of your investment. Therefore, it's essential to keep an eye on the payout ratio and understand what it signifies about the company's financial stability. On the flip side, a lower payout ratio might indicate that the company is retaining more earnings for growth and expansion. This could be a positive sign, suggesting that the company is investing in its future and has a buffer to weather economic downturns. In conclusion, the payout ratio is a vital tool for assessing the sustainability of a company's dividend payments. By understanding this ratio, investors can make more informed decisions and choose companies that are likely to provide stable and reliable dividends over the long term. So, next time you're evaluating a dividend-paying stock, don't forget to check the payout ratio. It could be the key to ensuring your investments are both profitable and sustainable. Earnings growth, the engine for dividend hikes. Now let's talk about earnings growth, because at the end of the day, dividends need to come from somewhere, and that somewhere is earnings. Think of earnings growth as the engine of a car. The faster the engine, the faster the car can go. Similarly, strong earnings growth often translates to bigger and better dividends down the road. When you're checking out a dividend stock, don't just look at the current earnings, dig a little deeper, and analyze their earnings trend over the past few years. Is it consistently growing? Is it stagnant? Or even worse, is it declining? Ideally, you want to see a company with a solid track record of increasing earnings, because that means they have more cash flow to potentially increase those dividend payments. Remember, a company that's constantly growing its earnings is like a well-oiled machine. It's in a much stronger position to support and even increase its dividend over time, which is what we want as investors. Alright, let's talk about free cash flow, or FCF for short. This is the lifeblood of dividends, the fuel that keeps those dividend payments coming. Imagine a company's revenue as a giant fire hydrant with water gushing out. Some of that water goes towards operating expenses like paying employees and keeping the lights on. That's like the water flowing through the hose. Now, whatever water is left over after covering those essential expenses, that's free cash flow, the water that's free to be splashed around, or in our case, paid out as dividends. Companies with strong free cash flow are like those giant water parks with endless slides and wave pools. They have plenty of cash to splash around, including paying and even increasing dividends. On the other hand, companies with weak free cash flow are like those inflatable kiddie pools. They might be fun for a little bit, but they don't have the same capacity for excitement or, you guessed it, dividend growth. Now, let's talk about debt. Debt is a double-edged sword in the world of finance. It's a fact of life for many companies, a necessary tool to fuel growth and expansion. But too much debt can be a major drag on dividend payments, and it can lead to financial instability. That's where the debt-to-equity ratio comes in. This ratio is a crucial metric for investors. It tells you how much debt a company is using to finance its assets relative to its equity. A balanced ratio indicates a healthy financial structure. Think of it like this. Imagine you're buying a house. The process is quite similar to how companies manage their finances. You put down a 20% down payment, which represents your equity in the property, and the bank loans you the remaining 80%, which is the debt you take on to complete the purchase. That loan is debt, and your down payment is equity. This balance is crucial for maintaining financial health. The debt-to-equity ratio in this case would be 4 to 1, meaning for every $1 of equity, you have $4 of debt. Now back to companies. A high debt-to-equity ratio can be a red flag for investors and stakeholders. It indicates that the company is relying heavily on borrowed money to operate, which can be risky, because it means the company is relying heavily on borrowed money to operate. This can lead to financial strain. This can be risky because those debt payments eat into the cash flow that could be used for dividends. When a company has to allocate a significant portion of its earnings to service debt, it leaves less room for rewarding shareholders. It's like trying to juggle too many credit card payments. Eventually something's gotta give. The company might have to cut dividends, delay growth plans, or even face financial distress. Therefore, it's essential for companies to manage their debt wisely. Investors should keep a close eye on the debt-to-equity ratio to ensure their investments are in financially sound companies. A balanced approach to debt can help companies grow sustainably while still providing returns to shareholders. It's all about finding the right balance. So, the next time you evaluate a company's financial health, remember to check its debt-to-equity ratio. It can give you valuable insights into how well the company is managing its finances and whether it's a good candidate for your investment portfolio. By understanding and monitoring this key metric, you can make more informed investment decisions and avoid the pitfalls of companies drowning in debt. Stay vigilant, stay informed, and don't let debt drown your dividends. Finally, let's talk about dividend history. This is like looking at a company's track record for paying dividends. Has it consistently paid dividends for years, even decades? Has it increased those dividends over time, or has it cut dividends in the past? Companies with a long and consistent history of paying and increasing dividends are often called dividend aristocrats. These are the companies that have proven their commitment to returning value to shareholders through thick and thin. They're like the reliable old pickup truck that always starts, even on the coldest winter mornings. Now, a company's past performance doesn't guarantee future results, but a strong dividend history is definitely a good sign. It suggests a company is committed to its dividend program and has the financial strength to support it. Of course, you still need to consider all the other factors we discussed, but a solid dividend history is a great place to start your search for dividend-paying stocks. There you have it, guys. Those are the key metrics you need to know to evaluate dividend stocks like a pro. Remember, investing in dividend stocks is a marathon, not a sprint. It's about finding those solid, reliable companies that can provide consistent income for years to come. So, do your research, be patient, and don't be afraid to ask questions. Thanks for watching. If you found this video helpful, make sure to like, subscribe, and hit that notification bell for more investing insights. If you have any questions or need clarification on any of these metrics, drop them in the comments below. Happy investing, and I'll see you in the next video.